On today's show, 3 questions. Number 1, why hasn't this market joined the rally? Number 2, are you smarter than your parents? And number 3, do you want to play a game?
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dentist Money's 2 Cents, where we help dentists navigate all the noise. I am Matt.
I'm Cody.
And I'm Rabih.
Yeah, you are. What's up, guys? How are you?
Good. How are
Doing
you?
awesome.
I'm doing
Never
great.
better.
I love May. Let's just say this. May, I think, might be in Utah,
Okay.
May might be my 3rd favorite month, I think. It's top 3 for me.
Are you a Star
Sep-
Wars fan?
What?
Are you a Star Wars fan? Is this why?
Oh, May the 4th be with you? No,
Yeah.
that's not it.
Yeah,
Just
should we
from
talk
like
about how Matt showed up to the office dressed up as Darth Vader last week?
No, I just love, so September, October for sure. I'm a classic fall girl, as they say. You should go see the Jim Gaffigan bit about that, about being a fall girl and making fun of people who are like, I love fall. Obviously September, October in Utah are incredible, but May's incredible. I love May. I love just the vibes. Summer's around the corner. The weather is perfect. Everything's blooming. Anyway, I've just been feeling great lately because of the weather.
I agree. I've been since the last week until today. The weather finally allows us to go take a walk.
Yeah,
Before
so
sunset.
nice. And it's not
beautiful.
hot yet.
Yeah.
It's great.
It's finally warm enough in the mornings too. Like you wake up in the morning and it's not dark
It's
outside
nice.
and it's
Yeah.
warm enough to like go run or walk or just be outside and you're not like all bundled up and
Yeah.
cold and wet.
Yeah, run or walk or just like stand there. Yeah, either
Or,
way.
yeah,
And
just
you know,
stand in the sun.
yeah, just we all have our thing.
yeah.
Okay, a couple of housekeeping things. As you know, this show is brought to you by Dentist Advisors. If you don't know, it is brought to you by Dentist Advisors. If at any point as you listen to our content education, you want to talk to us, really easy, dentistadvisors.com. Click on the book free consultation button. And then, guys, we're coming close. We're about a month out from the Dentist Money Summit. And I'm feeling the pressure. I'm the kickoff speaker. Rabih, you're speaking. Rabih, you're basically done.
Yes, I am working on my PowerPoint between meetings, and it's almost done.
Nice. Well, I am not done. I'm feeling the pressure. I do this every year. This is our 3rd year of the summit, and every year, about a month out, I'm like, I probably should put this together. So I'm feeling pressure, but it's going to be amazing. Practice on your terms. Midway, Utah, June 11th through the 13th. If you would like to join us, and you should, it's going to be amazing. DentistMoneySummit.com for more information and to register. We have some room for you. So anything you want to say about there? How are you excited, Rabih?
Oh, I'm super excited, and I'm trying to tone myself down, not to put all my nerdiness on the slides. That's why I need to
You
run it by
should.
you.
No, put all your nerdiness. People love you for your nerdiness. That's why we love you. Well, let's jump in. Rabih, why hasn't this market joined the rally? What market do you refer to, Rabih?
Which one would you guys think?
You told me before, so that would be cheating. Let's let Cody guess.
Which market are you talking about? Just the stock market?
Geographic region. Which country?
Which country hasn't really been going up stock market wise?
Middle East.
And if you're looking at the doc, Cody, if you're looking at the doc, you can cheat.
He said Middle East, right? Which
he said Middle East. Yeah,
it's
a great guess.
A great guess because it aligns with what we think. But I was actually looking at performances for portions of the market, and I was looking at the year-to-date performance, and the US is up 8.3% year-to-date, considering today's great day. Developed markets are up 13%, and then emerging markets are up 23%. And I'm like, this is for the year-to-date, and I'm like, this is amazing. So what countries come to mind when you think of emerging markets?
Emerging is
China
and
right?
India and
BRICS
South
countries.
America.
South America, this is what happened. So I went in, and this is what, when you're looking at performance, you try to decompose it. And I was like, okay, who is driving those 23%? Who is bringing? And to my surprise, I wasn't really paying that much attention to it, but China's performance year to date is down 3% for the year.
Whoa.
Right?
No way.
Well, China's like around 70% of emerging markets. So what is happening for the index to have a 23% return year to date, where the biggest component is still down 3%?
Yeah,
so
that is wild.
It is wild. So if you look at emerging market performance excluding China year to date, which there are ETFs that track it, this is up 35% for the year. Once you add China's performance, they average to 23. And there are two countries mainly, the big three of emerging markets, equity-wise. I'm not talking the size of the economy. I'm talking about like stock market performance-wise. They've got China, you've got Taiwan, and you've got South Korea. And Taiwan and South Korea have been on a run in terms of the impact of AI that's been having on their stock markets. In Taiwan, we've got the TSMC, the semiconductor chip that kind of has a monopoly on the smaller chips around the world. The stock has been flying to the moon, as they say. And also in South Korea, which we might cover next week, we've got Samsung Electronics, right? There was a time where there was a fight between iPhone and Samsung Android. Right now, iPhone kind of won it in the US, but in the rest of the world, Samsung is the winner. And
The US want to be different there.
We will not, like the metric system, we are not messing around with any Samsungs. Yeah.
It's not the first time we would do something like that.
Exactly.
So AI has had a very big impact on the stock price of Samsung, and that has been leading the South Korean markets up. So this is what's really driving emerging markets right now. Like when you think of emerging markets, do not think of China, think of Taiwan and South Korea. This is where we stand. But I was super interested in trying to understand what is happening with China. And I know we've covered it a couple times before. I wanted to tell you, or kind of give you an update for why China hasn't really joined the rally. Why hasn't it going up? So I'll do a quick revision, but I was going to go and find the dates of the previous 2 cents where we talked about China and throw them in, but I got too lazy. And with China, what's been happening, I'll just start from COVID really quickly, where like the main differentiating factors on how they manage the economy versus the rest of the world. In COVID, instead of them deciding to keep the economy open and have people work from home and have masks on, they decided to do a total shutdown, and people could not go, stores did not open. In the US, that created inflation. In China, that created a recession. And then in 2021, which is a major thing for China, they decided to do a crackdown on tech leaders and tech companies. The regime thought that tech companies have become too big and too strong and too powerful, so they had to do a crackdown on it. And the stock market, the Chinese stock market, as a result of this crackdown, it dropped, if you look at the Chinese ETFs, from its high in 2021 down to a low of negative 55% by end of 2022. So in almost like a year and 10 months, the Chinese stock market, the index, the whole thing, dropped 55%. And if you guys know compounding, when a stock drops or an index drops 50%, then it needs 100% back to get back to its initial levels. And unfortunately, it hasn't gotten back yet. Although there has been stimulus along the way, but it hasn't gotten back yet. We are still down like 23% from the all-time high for China. And part of the reasons for why it hasn't recovered is that the economic model of China has really been under a lot of stress. If you guys remember 2023, 2024, there was the Evergrande real estate developer in China that got defaulted. It kind of defaulted on its debt. Let me just give you an example of how the US economy runs, how the cycle closes the loop on itself versus how it is in China. And we can talk about sustainability of the economy in that sense. In the US, we all work, right? And we're a consumer society. We consume all of this money. That money, it becomes profit for companies. Companies gives us even higher gives us raises, right? Increases our paychecks, or company stock prices go up and we invest our 401ks, all of our retirements in the stocks of these companies, so they go up. So
Cody's like, who's getting a raise?
I was like, raises, all
He's
right.
like, we're talking raises. Let's chat.
Corporate America raises a little bit more than the rest of the world. So what happens is that the wealth effect, we're going to call this the wealth effect, closes the loop. You work, you consume, companies make money off your spending, their stock price goes up, but you own that stock price, you feel wealthier, so you spend even more, and the cycle keeps going on. So there's a wealth effect that closes the loop on the economic cycle, right? Similarly, this was the way it was in China. But in China, they don't have 401ks and pensions, etc. The main driver of wealth for the households, 70% of the wealth of households, comes from real estate. So what used to happen in China was that people would go work, would buy an apartment or a house, and that apartment and house goes up in price. They feel wealthier, and they deposit more money in the bank because they are a saving economy, not a consumer economy. Whenever we make money, we spend it. Whenever they make money, they save it. In China, banks are really connected to the state. So once you deposit your money with the bank in the US, the bank, invests it in other businesses, sends it out as loans. In China, when you put money in the bank, the state can determine where that money goes. So the state takes that money
and whether you get it back or not.
To a certain extent, but you need a minimum level of trust, right, for people to put money in the banking system. So the government is going to give you your money back, but instead of giving the banks the authority to decide on how they would allocate the investments or the deposits that people put in their banks, the state guides it, and it's been guiding it towards what? Real estate and real estate developers. This was pre-2023, before that big stock market, real estate bust that happened in China. So what would happen was that you put your money in the bank, the country, the state decides on allocation projects. They were focusing on allocation projects related to real estate, which increases your apartment value, creating that wealth effect, closing the gap, allowing you to feel that you have more money and save that money back again in the bank. So the state reinvested back in real estate developers. That was the loop. In 2023, the state said that this might not be a sustainable path because it's creating real estate bubbles. So what was going to happen? It became so bubbly to the extent that people were already paying mortgages, paying monthly payments on houses that haven't been built yet. Like, this was the state of the Chinese real estate market.
Did they not learn from us in 08, 09?
Yeah, but it's economic systems feed on themselves, and whenever you got a loop that is closed, it's like electricity. It short circuits and just goes into steroids. We have it with meme stocks. We've had it in 08. We've had it with the dot-com bubble. This is a function of how money moves. So the Chinese government, for good, it could be good or bad, decided that this is could be potentially very problematic. So we're going to start deflating this bubble instead of having it pop. So they issued a bunch of laws that prevented these real estate developers from taking more loans from the state, right? And it actually trickled down for them having so many houses that were never completed, and them not able to pay back the people. Like, people stopped defaulted on their mortgages because
there was no home.
I'm paying you a mortgage for a house that I do not doesn't exist yet, and you decided to stop building, right? So it affected, and the wealth of Chinese people actually took a hit. Just like in 08, when, for example, the stock market crashed in the US, everyone felt poorer. Everyone in China, the households, I'm talking the people, felt poorer simply because the value of their houses went down or kind of stayed flat since 2023. And this has kind of made the Chinese economy go into this stagnation where there's not much happening. People aren't really excited to spend or, stimulate economic activity. And by the way, if you guys remember, gold really started spiking in 2023. And initially we said, on top of central banks buying gold, it was also the Chinese people buying jewelry and hoarding their money and their assets in jewelry, because the stock market is a no-go in China. people think it's gambling. The state can intervene with it whenever they want. So they do not put their life savings in it. They had real estate to put their money in it, and not anymore because the state decided that, this bubble has grown big enough and we don't want it to grow any bigger. So a bunch of real estate developers defaulted. So the last resort for them was to put in precious metals and jewelry. So there was a hike towards gold. But putting all your money in gold does not close this economic loop, this economic circle. You might get a wealth effect if gold goes up, but it doesn't trickle down to the economy. So what has been happening since 2023, there were a bunch of stimulus packages, and there was even a certain law that said the state is going to buy in the stock market to help the stock market go up. We covered it on a podcast with Will, but that didn't really stimulate the economy or get people to start spending again, and didn't really show the success it intended. So what has China been doing since then? All the money that people are depositing in their banks, because it's a country of savers, they are taking that money, and instead of directing it to real estate, they're directing it to manufacturing. EVs, cars, solar, green energy, chips, and
through companies, or like actually buying those things?
Through companies. In China, the system is every single company there's a certain ownership. I'm not sure if it's controlling or less than controlling, but influential portion of the company is owned by the state. It's very similar to when, this presidency bought a portion of Intel, right? And Intel has gone up, and the president tweeted that, we've made that much money for the government because we invested in as Intel as a company. They do the same with Tencent, Alibaba, all the other Xiaomi, the car, BYD, all these big Chinese companies. The government has a part ownership in them.
Got it. So they're directing those funds from the banks into these companies.
And what has been happening is, and this is the story of China in the last year and a half, what's been happening is that the government has pointed all these resources towards production capacity and technology, but their consumers did not feel richer because it's the companies making money and they're not buying. So they've got a lot of production and not a lot of demand, a lot of supply, not a lot of demand. So what have they been doing? China has been flooding international markets with very cheap goods because the people inside China can consume them. They're not feeling as rich. They don't need them as much. We're overproducing cars. We're overproducing solar panels. We're overproducing other products, cheap products. So we're going to flood the markets and compete and kind of hurt other economies. The impact is hurt other economies. That's why, for example, in the US, they are not allowing any Chinese companies to come in because you can buy a car that is more competitive than a Tesla for 15 grand, right? So
you and I talked about this, yeah.
So this is how the whole story connects from, COVID to how the economy was struggling to what the government decided to do and where they are right now. And they are right now where they are allocating resources, overproducing, but that production is either getting consumed by the rest of the world or is just sitting in inventory in China because people are not spending and or completing that cycle. So what's happening in China right now is that you do not have a closed loop, economic loop. People are working, they deposit their money in the banks, the state directs that money to be invested in technologies, they are overproducing, there's not enough buyers, whether it's in the rest of the world or within China, to buy these stuff. The cycle is not closed. There's no economic value created. With that happening, you do not expect equity markets to reflect it. There's no wealth effect showing. And that is why China has not been able, although China, technology-wise, they've got, aside from the US, China is the biggest leader in AI. If you watch documentaries about the economic growth of, economy-wise,
which I know you have been,
I'm always on top of date on these stuff. So the message I want to get across at the end is that the fact that their stock market is not going up does not mean that economically they are not really a leader that is a very big threat to US supremacy economically. It's just that the value is not being distributed back to equity holders. And that is why the stock market is going up. The stock market is not the economy. In the US, our economy is kind of fragile, but the stock market is going through the roof. In China, their economy is pretty strong and their technology is way ahead of the US in certain places. But this is not translating to a stock market that's going up for them. So this is what is happening and how you would look at it. And it seems like, in terms of an allocation decision, unless there becomes a shift that closes this economic loop where value can trickle back down to shareholders, China is not going to be participating in equity rallies for the time being. So
super interesting. Go ahead, Cody.
Yeah, Rabih, tell me, and maybe you touched on this and it just went over my head, but why are the citizens in China, why are they not buying more of these goods that are being produced? Like, these factories and companies are producing all these products. Why have the citizens not been purchasing all of those? Like, what's holding them back?
there are two things. One is just the wealth effect. Like, if you do not feel richer, you're only going to be spending on necessities and not on other discretionary stuff. Not every single Chinese household wants the robot in their kitchen making them coffee, because there are robots in China making coffee on the streets, right? Like, not every family wants that person in their house. They're fine without it. The other part is that culturally, they're a producing type of economy, not a consumption-based economy. China is trying to get them to become consumers like the US are, because that's a more robust economy. But right now, they're a producing/exporting type of economy. And you actually notice it in their culture. Like, they say, people in the US brag on how much they spend on stuff. People in Asian countries brag on how much they were able to save, right? It's culturally different, and that translates economically with a different footprint.
Yeah, that's what I was thinking. Is to that exact point, Rabih, is you're not going to change culture you're not going to change that like cultural mindset with tactics from the government or whatever, and you're certainly not going to change them quickly.
No.
It's like a generational it's going to take a generational shift or some other catalyst to actually change that. So that's what I think is interesting. And that China's just like, well, we're just going to produce all this stuff and try to flood other markets, like you said. So you're saying the US has blocked certain items, or really just everything? I know the EV, we talked about the cars, but anything else, like the US is literally just saying you can't come into our market with this
Well,
stuff?
they didn't really block them, but here's the thing, and this was imposed by the Biden administration. The Biden administration imposed a 100% tariff on EV cars from China. So when the car used to cost 20 grand to come in, now it costs the American consumer 40 grand. Well, that's comparable to a Tesla, so I'll just buy a Tesla instead. What tariffs try to do is that they make cheap foreign products expensive enough to be competitive with domestic products. But who pays for them? The
Equalize
consumer.
it. Yeah.
Yeah.
Protecting
this is
against
what happens.
deflation.
Yeah, I do not know if someone can import, a BYD car into the US. It could be possible. It's not like, oh, you'll go to jail if you import a Chinese car into the US.
They
But
just would probably tariff it.
if it's too expensive and there's a tariff and then there's shipping costs, you're better off just buying a domestic car. This is the whole idea.
Yeah, makes sense. Go ahead, Cody.
No, I mean, I was just thinking, it's so interesting how different the cultures are, where they are more worried about how much they're saving. And like you're saying, they brag about, this is how much I've been able to save, versus in America, we brag a little bit more about, this is how much I've been able to spend. Maybe we could learn a little bit.
Maybe we could find some middle ground.
We could, that might be good for us a little bit.
Yeah.
But I just wonder what the difference is. Like, why is their culture that way, where they focus so much on saving, where we focus so much on spending? I just think that's interesting.
Yeah, that is. I also think it's interesting, Rabih, to your point around, we've talked about this in the US, this wealth effect, or this like disjointment of like what's happening in the market versus the economy, or what's happening in the economy versus how people feel. Just every time you go through something like this is yet another example of the epitome of kind of navigating the noise, of seeing kind of that confusing figure of like, wait, why is emerging markets dominating, but China is not? And then your explanation is like, try figuring this out. from an investor standpoint. Like it's every time we go through something like this, I'm like, there's so much noise here and so many things to figure out that it's just really difficult to be able to guess where this is going to go from, day to day, month to month, year to year. So anything else, Rabih, on that explanation with China or what's going on with them not joining the rally?
No, that it might be, but what we need to remember is that these are economic phases that only last a couple of years, and after that, the whole narrative might switch, right? If suddenly there's suddenly all this direction of state-funded or state guidance money goes into technology tech startups, and China becomes even bigger than the Silicon Valley in the U.S. And a bunch of billionaires and new billionaires start getting created in China. This completely shifts the narrative, and suddenly the capitalist drive or the entrepreneurial drive might close that economic loop, and China become a great place to invest again. So what we're saying is that the analysis right now is not a verdict on the market overall. It still has to stay a portion of your portfolio. It is a part of your portfolio. Yes, it's down 3% for the year, but that sleeve, emerging markets, is still up 23%. When the tide flips or the table flips, you still want to be exposed just so you're not left behind in the dust.
Yeah, it's a basic fundamental aspect of investing being diversification and own the global market for this exact reason. So, yeah, that's great. Okay, let's move on. Cody, are you smarter than your parents? I couldn't help but think about my 4-year-old son, who, yes, is teetering on the edge of already being smarter than me. Just for the record,
he's getting there.
he's getting there. It's like he's going to be 5 in about a week or so. And I think in the next 6 months, I'm going to give it an official stamp of he's smarter than me. So
it happens.
Yeah,
it happens.
he's
There's
there.
nothing you can do about
Yeah.
it. Yeah. So I saw the stat this morning. I was looking at it that I thought was so interesting. So there was a survey, well, basically a test that was done where a lot of people came in, they took this exam, and it was a financial literacy exam. And they had different age groups doing it. So you've got Gen Z, you've got millennials, you've got baby boomers. And this financial literacy test, we're not talking Rabih level stuff here. This is like the basics. This
like
is
Matt level.
Yeah, the Rabih level, then the Matt level. So
Yeah.
we're not even close to that in this exam. But it's like basic budgeting and saving for the future and how to handle money challenges and money emergencies and things like that. And I thought that the results here were so interesting. So Gen Z, only 38% of the people that took this exam are considered financially literate, according to this test, which I felt like was pretty low, honestly. And then you've got millennials, it goes up to 46%, Gen X is 51%, and then baby boomers is 55% of baby boomers are considered financially literate. All of these levels I honestly thought were lower than what I would expect. But what was interesting, and well, part of this is it makes sense that each generation, they're a little bit more financially literate than the previous generation. I just think through experience, right? You just learn things along the way. Yeah. Experience, mistakes. There's just things you pick up along the way. But what was interesting to me is another survey was given out of which generation attends the most financial conferences or financial classes and things like that. And Gen Z was the highest. 35% of people that took this survey said they attended some type of financial class within the last year. So it was weird to me. Gen Z seems like they're consuming the most financial content, but they're the most financially illiterate, according to this survey and this exam. I don't have an answer for that, but I thought it was interesting. I don't know if maybe these classes they're not like general, let's talk about budgeting, let's talk about an emergency fund, things like that. I feel like all of the content that we consume on social media and these classes are all like I can show you how to pay off your mortgage in 3 years without increasing your payment, or
Make
you
money
should get
without
in.
paying taxes. Yeah.
Yeah, like here's this tax loophole. So I don't know. I don't have an answer for this, but I just thought this was a really interesting statistic here. So
Yeah,
I wanted to get your thoughts on it.
that is very interesting. The first thing that comes to mind for me is what are we defining as a class and like education?
Right. Is
And
that just TikTok? And they're like,
yeah,
oh, I follow
exactly.
this guy and this is where I get all my financial information from. Yeah.
Yeah, I don't have it in front of me, but we've talked about this before, like the percentage of people getting their information and or quote unquote entertainment, financial entertainment from TikTok. It's astounding and scary. So, but Robbie, what are your thoughts?
Yeah, I'm like, maybe they're modest. Maybe they think, oh, I don't know enough, and I'm gonna consider myself literate. But I also, something that is interesting, is this the same test that was administered to the boomers, Gen X, millennials, and Gen Z? Because I feel the personal finance world of Gen Z is completely different than those of boomers. Like boomers didn't really have ETFs to start with. Boomers did not have daily trading on Robinhood, zero commission fraction shares. It's like the financial world has become more customized and more you know detailed and complex. And is it the same test? Like I if you if you ask a Gen Z about a pension, they're not gonna go know what that is, because this day and age, all we have is defined contribution plans such as 401k. So is just the test outdated? This is what came to my mind.
Yeah.
Right. Maybe. Yeah. I wish I had more information on the exact like test questions that were asked. I don't have that. But you do bring up a good point that maybe things are more complex now for Gen Zers than they are for baby boomers. And so maybe to be considered financially literate, you do actually have to know more than our grandparents or great grandparents just because things are more complex now. It's possible.
Yeah, I question the word like are truly I don't know the answer to this, but are they more complex or are we just being flooded by more crap? Like,
Maybe.
right, like
Yeah.
I don't know if the core principles have changed and or will ever change regarding building wealth, but no question today it has never been harder to navigate all the crap that's coming at us and the 24/7 365 people out there throwing stuff at you trying to get you to believe they have some secret. Like that's always been there. Like the classic snake oil salesman has been a thing for, multiple generations, probably since the beginning of time, but the access to proliferate that information, the ability to do that has never been greater. So I don't know if things are more complex. I think things feel more complex or harder to navigate, but I think it's more just the information age we live in,
Yeah. I like the way
but
that
I'm
you
open to
phrased
being
that.
wrong.
I like the way that you phrase that with, are things actually more complex or do they just feel more complex?
Yeah.
Because maybe, I mean, that I think is true. Things feel a lot more complex. There's so much more that's thrown at us just with social media and podcast. I mean, there's a million ways that we can consume content now. So, yeah, it's interesting. Are we actually not as smart as Gen Zers, or do we just have more content we have to sift through? So,
Yeah.
I don't
Yeah.
know.
It's interesting. Yeah. I, as far as like our Gen Z not as smart, I don't know if that's the case. I think it's never been easier to be lazy though when it comes to getting
Sure.
information or, you know, gathering lies. But Robbie, any final thoughts on this?
No, this study could also be noise, just like the other noise that we look at.
Right.
And like studies on intelligence, they were like comparing us to our grandparents versus the new ones. And even for like the last 1,000 years, like the human brain really didn't evolve over the last 1,000 years. We're not that much smarter than people from 500 years ago. So I don't think it's just going to switch from one generation to another.
Yeah. I also have a hot take here. I don't think we have a literacy problem in America generally. I don't think information or literacy is our problem when it comes to people making poor wealth decisions. We have a discipline problem.
Oh yeah.
Like, I don't think literacy, I think actually a lot of people hide behind literacy, like, "Oh, I don't know enough." It's like, no, I just think you are not disciplined and you don't want to actually make the consistent decisions required to see good results. But is that too harsh? Maybe I'm being
No,
harsh on this
I
Friday.
love that take.
Uh, yeah.
Let's strike the
Hey,
whole country like an army.
yeah,
Just kidding.
there you go. That's great, Cody. Really, really, we should maybe expand on that for a bigger show. Okay, let's wrap up with the final question here. Do you want to play a game? Do you guys want to play a game?
Yes, you've
Let's
teased
do it.
this.
I know I teased it. I haven't shared anything with you guys, but came across this, and Robbie's probably going to be like, "Yeah, I totally know this." Came across this study around this game that was played. It's called, I guess we'll just call it the coin flip game. And you can go do this. So if you're listening to this and don't want to know the actual data here, or the answer, we'll say the optimal answer, you can actually go play this at Elm. Shout out Jake Elm. This is not Elm. This is not Jake Elm. Totally separate. But elmwealth.com. And there's on that, there's the simulator, this game that you can play. So this was from a while ago. It's like 10 years ago. This group got together 61 subjects to play a coin flip game. And here's the game. You get $25 and you flip this coin with this simulator. The simulator is a 60% probability of it being heads and a 40% probability of it being tails. You have 30 minutes to win as much, or to turn that $25 into the highest amount possible. They did put a cap, and the winner of the game, how you win this game, is by 10xing your money, getting you to $250 within 30 minutes. So that's it. That's the game. So then the question here is twofold. Number one, how would you bet? Maybe it seems a bit obvious. We can hit that. But the most important thing is, how much do you bet? How do you actually bet this to maximize your dollar amount in this constrainment of time, 30 minutes? I'm going to leave it there for a second, and I'll break down the study and the results. But there is an optimal strategy here that they break down. But I'll go into that. But any response or initial thoughts? Robbie's brain is already turning.
Yeah,
and
and I
churning.
was thinking so much that I kind of missed the second part of what you were saying.
Oh.
So you said it's a coin, 60% probability heads. You have 30 minutes, and then what?
So it's 60% chance of heads, 40% chance of tails. You have 30 minutes to maximize your money. You have $25. Your goal is to bet the heads or tails as many times, or just, bet it, and you can put any amount of money you want on your bet.
And
within
the
$25,
if you
obviously.
put $1 and you get heads, you get the $1 back. If you get tails, you lose it.
Yep. So they brought these people in, 61 participants, and they played this game, and they wanted to see kind of the results of how they fared, how they bet, what their behavior was. And they have these results. But I just wanted to get your guys' thoughts, if you have any.
Man, that is a great game, honestly.
It's kind of interesting.
That is really interesting. I mean, like you said, there has to be an optimal way to do this, like just mathematically.
There
I
is.
don't know the answer, but I don't think you want to bet all $25 on the first flip. I'll say that's probably the first step.
They had people that did that. Yeah.
But I don't know.
Robbie's thinking.
No, I've seen stuff similar to that one. It's called the Gambler's Ruin. And it's usually what determines at the end of 30 minutes, or at the end of like a long game of blackjack, whether you end up winning or losing, is whether the probability or the odds are in your favor. Given that the odds are in your favor, right here, Matt, 60% in your favor, it means that you would want to survive as long as you can, because the longer you survive, the higher your probability you're going to be making money. So you would want your bankroll to be as big as possible. So if it were to me, I would bet a cent every single game, or like a very small amount, so I can stay in the game for longer than I can and have that drift take me up there.
I'm totally with you, Rabih, and I'm so glad I was thinking just like you. But here's the key. You only have 30 minutes. So an infinite amount of time,
you would want to go cents.
Fits more, or you'd want to go smaller perhaps. But there's not an infinite amount of time they're saying to find that time, and maybe it doesn't matter. I actually don't know that for certain if the time necessarily matters, but I would assume it matters more when you've got a limited amount of time, being 30 minutes.
It will, having a stopping time of like 30 minutes will definitely affect the bet size that you are going to be choosing.
Yeah.
I
So I'll give you the results first, and then I'll give you the optimal answer here.
Okay.
So they have a quote from here. It's, how did you go bankrupt? Gradually, then suddenly. From Ernest Hemingway in 1926. But the subject says, I'm sure you can guess, did not do very well. By the way, they had various people from different backgrounds, but they actually had some pretty financially literate people. So they had 14 analysts, associate level employees, from two leading asset management firms. They had 49 males, 12 females. They had, they said primarily comprised of college-age kids, but all of these college-age kids were in economics or studying economics or finance, or they were young professionals at finance firms. So literate people when it comes to finances and investing. They did not do very well. So the winning of the game was getting to $250 in 30 minutes. Only 21% of participants reached that maximum payout, which is, they say, well below the 95% that should have reached in a given simple constant percentage betting strategy that they'll highlight here in a second. So there's a 95% chance, if following this betting strategy, of actually achieving the $250 payout. So I'll just kind of break this down. Let's see, the average ending bankroll of those who did not reach the maximum and who also did not go bust, which was 51% of the sample size, was $75. So the average person reached 3x their money, $75. What's interesting is almost 30% of the people went bust. They actually lost completely all their money. Again, the biggest sample size was between 25 and 100, with the average being 75. What is even more interesting here that I thought was kind of crazy is they started kind of looking at these people's behaviors, and people actually started trying to guess like streaks. So they kind of fell for this fallacy of, they'd get like 3 or 4 heads in a row, and they're like, oh, I'm on a streak, I'm gonna double down. And they actually found a lot of the people were starting to bet more on following like a streak of 3 or 4 or 5 heads in a row, which if you really think about it, take a step back, is a complete fallacy, because every single flip has the same percentage every single time. What's even crazier is that they found a good chunk of participants actually started betting or had some bets on tails. About 25% of bets were on tails, which is wild to me. That you would think that at the very minimum, everyone would just think, I'm betting heads every single time. The game is not that. The game is, how much should you bet? So I'm going to leave it there. Any other thoughts or questions before I get to the optimal strategy here?
No, it makes sense, and I'm gonna take a guess on how you'd solve this. I might be wrong. I'm splitting myself out there. But when you're in an experiment with constant probabilities such as that one, and the probabilities are independent from one trial to another, a good allocation formula that people use is called the Kelly criterion. Is this what is used?
Oh, this is crazy.
Freaking Rabih. I knew you were going to get to this.
Rabih just has the internet in his mind.
Oh my gosh. Go ahead, Rabih. Go ahead.
So I don't have like the formula in my mind, but the Kelly criterion is a ratio where the probability of success of the flip determines how much as a proportion of your kind of bankroll you should allocate for the bet. And it's just an optimal one. And the Kelly criterion tells you that if you bet too much, you might bust. And if you do not bet enough, you might not get as much money as possible. Probably the thing you have has more details, but this is the concept, just mathematically.
Freaking Rabih.
I'm sorry.
I knew you were going to get to this. Like, for the record, everyone listening, Rabih had no clue what I was talking about here. I didn't tell him the topic beforehand. And of course you get to it. So John Kelly, 1956, comes up with the Kelly Criterion. Freaking Rabih. So exactly what you're saying is there's a formula that gamblers have now since learned, and investors as well. This has caught the attention over the last, since 1956, of like Warren Buffett, Bill Gross, James Simons, kind of using this criteria. And it's exactly what you said, Rabih, that there is there is a mathematical formula with constant variables like this that you should go. So the basic idea is that the Kelly formula is that a player who wants to maximize the rate of growth of his wealth should bet a constant fraction of his wealth on each flip of the coin. This function is defined by 2 times p minus 1, p being the probability of winning. So that it comes down to, basically, after all of that, it says the Kelly Criterion would tell the subject to bet 20% of his account on heads on each flip. 20% each flip. So the first bet of the game, $25, you would bet $5 on heads. And if you win, you'd bet $6 because now you have 30. If you lost, you would bet $4 because now you're at 20, so on and so forth. So you'd actually just control and do 5%. I did not know. I played this game before this. I did not know the Kelly Criterion. I'd never heard of this before, but I feel okay with myself as a normal person, we'll say, not Rabih level. I had instinctually the same mindset, just not the right percentage. So I was betting about 3% every time, and I had no background in this. I was just kind of like, oh, I think 3%. So I would adjust it up and down based on that. I did not get to the 250, but got close. But there it is. It's about 5% every single bet. What are you guys, Rabih? You don't get to talk. Cody, go ahead.
Yeah, that's interesting. My thought was similar, where there has to be a certain percentage of your portfolio that you can invest each time. I would have thought it was way higher, honestly. Like, I probably would have done like 30 or 40% each time.
Yeah.
Now that's, a lot riskier, obviously, but yeah, that's interesting. I like that. Here's the thing about when it comes to finances, there's always a spreadsheet answer, and then there's always I would call it like a personal answer, or like a feelings-based answer. This, I like that there's a formula for this. Like, there is a right spreadsheet answer. There's an optimal way to do this. I think that's cool. So
yeah,
what was
definitely
the formula again? You said it was
2 times p being the probability of the flip minus 1.
Okay. Probability of the flip, as in like the probability of winning.
Yeah. So in this case, you have a standard variable of 60% chance of winning, which ironically, this is why this works so well with like stock market investing, because we've talked about this before, but the probability of having a positive return daily is about 55 to 60%. And as you expand that timeline, it actually gets much higher. But they were kind of trying to simulate the stock market, I think, for this game. All right, Rabih, we'll let you talk. Go ahead.
Okay, thank you. I was waiting. In finance, the question or the problem of how much do I allocate to a certain investment, to a certain stock, so I can optimize how much money I can get out of it, is an unsolved problem. It's like the cure of cancer. Like, it's a problem that the whole industry hasn't figured out. A Kelly criterion is one attempt. Sharp ratios is another. There's something called fractional Kelly criterion. There are so many ways for which we decide on how we would allocate to get the optimal result, ending result. The Kelly criterion, for those who apply it on stocks, they lose all their money, because the Kelly criterion will only work under these conditions that you mentioned, Matt. The probability is constant, which is not what we see in the market. The probability that stock market goes up today is different than the probability that it'll go up tomorrow. They might both be positive, but today it might be 60%, tomorrow it might be 40%. That changes from one day to another, which makes this formula no good. The other reason is that the trials are independent. The fact that you flipped 3 heads in a row does not mean that you're going to flip a tail. It does not revert to the mean. In the stock market, returns are not independent. The fact that yesterday it went up gives a bigger increase that tomorrow it might go down. That's what we see when crashes happen. The best days in the stock market are right after the worst days in the stock market. Returns tend to cluster, which also violates the assumption of the experiment that allows the credit criterion to work. So a lot of people who come from the gambling side and they want to do stock market stuff fall trap to this, and unfortunately been tested by many, including myself. The Kelly criterion does not work in the market.
Yeah. Yeah, I'm with you there. I just think there are definitely some lessons, and Cody, you were alluding to this, of although the Kelly criterion does not fit perfectly, and the reason being, Rabih, you highlighted, is the variables are so much more expansive than the constraints of this game. But what the biggest takeaway for me reading through this article and playing this game and thinking about it and seeing the results of the behavior issues of these participants really led to their destruction more than anything. Of, for example, trying to follow streaks and bet more on streaks, or the craziest one to me was literally betting on tails. But you see this all the time with investing, and it's, to your point, Rabih, it's even more difficult with investing. But I thought interesting takeaway from this, from one of my favorites, Rabih, you and I share this, our favorites of this guy, Nassim Taleb. He has a quote from this, or quote that relates to, I think, this, which I think is interesting, how this relates to investing. If you gave an investor the next day's news 24 hours in advance, he would go bust in less than a year. That's from Nassim Taleb. And I think that like wraps up, or that is a really good kind of closing thought from not me, but Nassim. So I'll give you guys final thoughts on any of this. Rabih's smiling. You also love Nassim. Go ahead, Cody.
Yeah, I mean, I don't have a lot of final thoughts on this. I think what Rabih said is interesting, where every day the market's different. And so I just think it's so important to go back to the basics, like go back to the foundation. We know what works long term. We know we can stick to that. There's not a ton of guesswork that has to go into that if we just stick to the fundamentals.
Yeah. Yeah, love it. Go ahead, Rabih.
Oh, I was so happy with Nassim's quote and then Cody's go back to basics. I was settled. But what I would say is, we might not know what happens every single day, but in the stock market, you're not investing for 30 minutes and you're investing for 30, 40, 50 years. And at that sense, because the drift or the probability is in your favor, just like in this game, the longer you stay in the game, the better you are, the better off you are. So because in the stock market, you don't have that 30-minute limit, what Matt and I were thinking of at the beginning is like, I want to bet as least as possible to stay in the game for as long as I can, is literally the mathematical way of saying time in the market beats timing the market.
Yeah.
And this is what we preach.
Yeah, love it. It's a game of survival. Love it. That was great, guys. Was that fun? Was that a fun little game discussion? Of course, yeah. Rabih freaking knows where I was going with that. I appreciate it. Okay. Really appreciate it, guys. Everyone, thanks for listening. We'd love to see you at the summit, dennismoneysummit.com, dennisadvisor.com if you want to talk to us. We'd love to hear your story and be able to help you. For now, everyone, thanks for listening. Cody and Rabih, thanks for your words of wisdom. That was our 2 cents. Till next time, have a great weekend. Bye-bye.